This is our Fed decision post-game show. I'm Tyler Matheson.
And I'm Sharon Epperson. Yes, here we have it. The Fed has hiked by 75 basis points, the biggest increase since 1994. Chairman Powell says that there could be another rate hike again in July. After rising ahead of the decision this morning, the markets continued to rally on that aggressive stance right into the close.
That's right. And we kick things off right now with an all-star panel to parse the decision. With us now, CNBC's own Steve Leisman, live from Washington, Rick Santelli from the CME, Nancy Davis, Quadratic Capital founder and CIO, plus CNBC Financial Advisor Council members Winnie Sun, founding partner of Sun Group Wealth Partners, and Douglas Boneparth of Bonafide Wealth. Welcome to all of you. That's a mouthful, Sharon. Let me start with you, Steve, because I think there are a couple of things. One of the things that I know you said by way of question to the Fed chairman and then afterward is the idea that the Fed, by raising interest rates and raising its prediction of where Fed funds will be, the Fed has now come closer to what the market expectation is. I think that explains in large measure why the stock market rallied the way it did, why bonds yields came down the way they did, and contributed to a sense of calm. Your thought?
Yeah, a little question, though, to what you're saying, Tyler. We don't know if the market correctly predicted where the Fed would go or the Fed went to where the market was. We don't know the cause and effect there, just to be clear. But the more important thing is what you say, which is that, first of all, the Fed had a completely unrealistic set of expectations and outputs that didn't make any sense. It had inflation coming down, unemployment remaining steady, growth being high. The new summary of economic projections we got today, I'm not saying it's right, but it sure makes more sense. You have inflation remains relatively high, comes down over time, unemployment rate ticks up, growth is slower than it was before, while the funds rate goes up. And where does it go to? It goes to 3.8% next year, 3.4% this year, 3.8 next year. It is one of the most dramatic increases I've seen in the Fed's adjustment between projections that has happened since 2011. So I don't know if it's right. Fed Chair Powell said it's plausible, but doesn't know if it's right. But it's certainly closer to where you think we'd have to go to get control of inflation. I'll explain very quickly why, which is you've got to have a positive funds rate. It's negative right now. You've got to have the inflation rate built into that, and you've got to have a certain restrictive element to it. So a 4% funds rate, what does that get you? Let's say you have 1% real. Half a percent real, half percent, and then you have 2 or 3% on inflation. That gives you a 4% funds rate that makes sense. It puts some brakes on the economy.
Steve, I'm wondering if there's anything to make of the post-meeting statement where the Fed normally says that they expect inflation to return to 2% and the labor market to remain strong, but we're just hearing this time they're saying they're strongly committed to that goal. Is there a difference there? Why the difference, and is that concerning?
Yeah, I mean, I think they're not so sure about the outcomes here that they're going to be able to bring it down to 2%. I mean, they're committed to it, but what they said is we're not sure it's going to happen at this point. So, yes.
Yes.
Hello?
I think that's someone else trying to check in there. Okay. Steve, continue your thought.
Oh, okay, yeah. Sharon, all I say is I'm not sure why that was eliminated, what it all means. It's very curious it wasn't there. It's a bit like the Fed chair or the Federal Reserve Open Market Committee decided we can't guarantee we're going to get there in any reasonable amount of time. You'll notice that over the horizon of the forecast, they don't get to 2% anymore. They get to 2.3 now.
Let me turn to Rick, if I might. Rick, did Powell sufficiently channel his inner Paul Volcker?
You know, I don't think he did. I think that Paul Volcker had a much better intuitive feeling for inflation. I think now these econometric models tell me that whether it was the ECB or the Fed or the Bank of England, they were all blindsided. You know, the last big powwow that our Federal Reserve had pre-COVID was, of course, talking about how they weren't going to be asymmetric with the 2% rate and how they changed all these dynamics. I guess what I'm saying is that I don't know that Powell has a good handle on why inflation crept up when it did. They certainly didn't see it coming, and I'm not as optimistic that they're going to be able to intentionally control it. I think it's more of a random walk at this point, to be completely blunt. And I think when you look at the models that they depend on, with output gaps and fill-up curves, I'd be much happier if during these press conferences, maybe the Fed would try to give us more information on how they're going to try to bring up to date their models to make them more correlating with the current activities of the way markets move and how people invest. And, you know, it's much bigger than just money supply. So are they on the right path? I'm not sure I know, because I don't think they know.
Well, let me follow up on that. Is Powell responsible for the inflation that we're having right now? Or is he responsible for not reacting to it quicker?
Listen, I think it was pretty obvious that when we started to talk so many trillions of dollars being thrown into the economy, when Powell and company wanted to backstop everything in sight, yeah, I think they should have had a better inkling that once the COVID started to become less of an issue, and they saw within several months in after March of 2020 that things weren't going to be as horrible, the corporate securities market wasn't going to collapse, they should have started to roll up the carpet a little bit, but they didn't. And what makes matters worse, Tyler, is that they were enablers. Okay? If the central bank of your country is going to allow the government to basically print at will and keep interest rates at a point and do cover for them, set a pick for them in essence, of course politicians are going to take every opportunity. When I look at how much money is still unspent with some of those programs, it really makes me a bit nervous.
Steve, you know, one more question for you. It seems that the Fed chairman is saying that largely optimistic about the outlook for the economy with higher inflation. Do you think that investors and the financial advisors that are watching have a right to be optimistic as well based on being in the room today?
You know, I'm going to echo what Rick said, which is the remarkable lack of confidence that the chair has in either outcomes or what needs to be done to get the outcomes that he needs. I think this creates an enormous amount of uncertainty. I would not feel a whole lot confident that we're on the right road of a place where you can be comfortable as an investor until we see a couple months of inflation rates coming down and flattening out, and you get a sense that the Fed is in the ballpark of where it needs to go. I wouldn't be surprised to see that there's a potentially mild recession here that would be coming. That would be something you'd have to watch out for. But let's be clear here. The market has gone a very long way of incorporating a very hawkish Fed. The question I have is, has it done enough? And that was my question to Powell today. He thinks we might be in the range. Rick's not so sure. I don't blame Rick for not being so sure. If we are in the range, there is a place to begin to nibble and be comfortable, but you need to be comfortable that we're within the range.
All right, Nancy, let me bring you into the conversation, and then Doug, if I might. Nancy, I was struck by one of the things that Chair Powell said in his press conference. No one knows where the economy will be a year from now. That on its face is absolutely correct. No one really does. But to hear it come from him, if you don't know, then what am I supposed to do? What am I supposed to do?
No, I think that's a great point. I mean, he even said it kind of felt right to do 75, which wasn't, you know, it's not confidence inspiring to go by feelings with hiking 75. Like, why not 150? You know, it just seemed kind of random. I think Rick's point about the random walk, I think we are officially in random walk territory.
So then what do I do? Do I wait, Nancy, like Kyle Bass said, until the fall, until I start seeing positive declines in inflation, until I hear the word pause enter into the Fed's lexicon to put capital to work?
Well, the inflation expectations market is significantly downward sloping in the rates market already. So the rates market believes the Fed hiking policy rates is going to ease inflation, and that's fully priced in. So other markets, whether you look at commodity prices or equities, other markets are not priced as cheaply as the interest rate markets are for inflation expectations, but it's very downward sloping. So the rates market is definitely in the disinflationary, slowing inflationary, even transitory, if we can use that dirty word again.
Oh my! That's so 2021, Nancy. Oh my goodness, Doug. Let me.
I know, right?
let me turn to you, Doug, quickly, and then I'll get Sharon back into the conversation here. I suspect that tonight or tomorrow you are going to be communicating with your clients. You are going to be writing to them, and you are going to put this rate move and what the Fed chairman said into your context. What are you going to tell them?
Yeah, I don't think it's something that necessarily is happening tomorrow, but a story that we've been sharing with them throughout the last several months. We've previously communicated that the Fed needs to get aggressive. We're happy to see 75 basis points because we feel we're behind the 8 ball here. And I think for any financial advisor, if you haven't been communicating with your clients, don't be behind the 8 ball on that. This is obviously a great opportunity to let them know your thoughts and what you think the next 12 months might look like and the things that they can do. There are going to be opportunities presenting themselves, if not opportunities that already are presenting themselves. So I think it's on us to make sure they know how to take advantage of that. And you're threading a needle here. You're threading a needle between the opportunities that you want to take advantage of and protecting yourself, everything from unemployment risk to even further pain in the capital markets. So again, that's our job. And I think everyone needs to communicate that, whether it's through your blog, your newsletter, or just picking up the phone and giving your most sensitive clients a phone call. But hopefully you've been doing this through financial planning and through constant communication since the beginning of the year and over really the last several years.
Yeah, well, Doug, a lot of your financial advisor friends back in here sharing comments, sharing questions, and Aaron Garrett has a really good point here, which is, Chairman Powell has one of the hardest jobs on the planet. And by saying what he said or didn't say, it just shows that the Fed is going to have to be nimble and play it by ear going forward. But that does not bring a lot of confidence to investors and the clients that you have to talk to. How do you tell them what to do next if the Fed is just saying we have to play it by ear? Or that's the interpretation of what the Fed is saying?
Yeah, if you're building financial plans around strictly what the Fed is saying, I don't know if you're building a pretty sound financial plan here. There are a lot of things that go into making sure people are in control of their financial lives. It comes down to fundamentals, what you're spending, what you're saving, knowing what free cash might look like to take advantage of those opportunities, conversations around their jobs and how safe they feel with their employment. And even just some of the more important stuff. Are they covered with insurance? Did they get their estate planning done? I mean, these are the core areas that make up sound financial planning. So if, again, you're basing this on just the uncertainty of the Fed, and the Fed is having a credibility problem, transitory, was the key word, as Tyler said, last year, and that didn't work out very well because here's inflation right now. So, I think it always comes down to helping people figure out what they can control versus what they can't. And if, the Fed is guessing here, what job are we going to do in terms of, how much better is our guesswork or our clients' guesswork around that? So focus on things you can control, and I've mentioned those just a second ago.
Absolutely. Nancy, I know earlier today when we spoke, you said, whether we're headed for stagflation, a recession, whether inflation continues, that what retirees and those close to retirement want to know is what do we do right now? That nervousness, that concern has probably not been alleviated very much by today's Fed decision and the commentary. What would you say that financial advisors should be telling them, those clients in particular?
Well, so markets, all markets, whether it's the stock market, the bond market, the rates market, all markets move with forward guidance on forward expectations. And the Fed has guided the market already to be quite hawkish. Another 200 basis points of Fed hikes are fully priced in the next 5.5 months. So the market has already moved forward those rate hike expectations. I would say the thing that I think is really interesting is inflation expectations in the interest rate markets are actually priced for this very disinflation kind of transitory outcome. And that's a good time to buy when the market is expecting Fed hikes to stop inflation and it's priced cheaply for future inflation expectations. I think it's a good time to be adding that to portfolios. I think the one thing investors need to be wary of is being diversified. And being diversified, you can't just, as Kyle Bass said, sit on the sidelines, to wait for the fall. people really should be thinking about their portfolio diversification. It's all not just about stocks. You can have a lot of other asset classes that can help diversify a portfolio and give those non-correlated returns to equities.
Yeah, so when it comes to what comes from the government, what we're going to see perhaps in the next economic report, Nancy, after the Fed decision today, what are you looking for next, and what perhaps can advisors tell their clients, this is what we're looking for next, so wait for this. This will give us some more guidance.
Well, I thought Powell mentioning consumer confidence being at very low levels was really quite dovish. I do think it was encouraging that they are watching other data other than just, what economists look at and looking at consumer sentiment. I mean, I think the Fed really should have talked more about using their balance sheet. I think the caps are in place. The balance sheet roll-off has started. Powell alluded to using the balance sheet as a monetary policy tool, but didn't really give us any more details about that. So I felt a little disappointed with, where's the meat, Powell? I thought we were going to talk about the balance sheet this time around, and it was a little disappointing.
I just want to see, is Rick Santelli still with us, or has he departed?
Yes.
He's still there.
I'm here.
Rick, let me ask you a question. One of the things we kind of got to, and I think you were driving at this earlier, is that Mr. Powell may have done too little, not soon enough, to curb inflation. Is there a risk, as David Kelly said on our air earlier today, that now he has waited too long and will succumb to a common Fed fault of doing too much too late?
I don't subscribe to that for one simple reason, although I think Mr. Kelly is correct. The reason I have an issue with it is because on the face of it, it sounds to me like Chairman Powell only gets so many hikes and cuts, and it's some special magic number, and he doesn't want to use up those wishes too quickly. I don't understand why they didn't go bigger, quicker, and then lower should they find that they overswung. The notion that they have to play it in this particular fashion of only tightening and stretching it out, and that if they hiked up and moved the rate immediately up to 2 or 2.5 or 2 3/4% like many wanted, some of the biggest institutional money managers in history, that was their call. What's wrong with then taking them back? But that doesn't seem to be ever in the quiver of this or any other Fed, and I think it, along with the poor set of models, is a giant mistake that they don't try to be more symmetric in their movements versus picking one direction and sticking to it and trying not to overswing. I don't think it's bad to overswing, but I do think that they didn't and haven't treated inflation on the high side the same way they treated the markets and their strategies when inflation was on the low side, and I think inherent in that is a major flaw.
All right, Rick Santelli, thank you very much.
And I want to thank Steve as well, and Rick, Nancy, Doug, all of you for joining us for this discussion. There's a lot to break down, a lot to try to figure out what to share with your clients from this Fed decision.
All right, we're going to run a bite here from Kyle Bass earlier today, where he talked about energy and the need to have a kind of more strategic thought about energy. We're going to run that bite right now. All right, let's move on yet.
Maybe the market's dropped enough. Maybe 30 trillion coming out of investors' pockets is going to have a severe chilling effect on global markets, which it will. It just takes time. So I think that a lot of their job is actually already done. I think inflation is going, I think you're going to see food and energy prices continue to head higher unless we have a massive recession.
We're going to get some more perspective on the Fed's decision. Now we're going to move on to the institutional side of things. And joining us now is Alicia Levine, BNY Mellon Wealth Management, Head of Equities and Capital Markets Advisory, and Allie McCartney, UBS Private Wealth Management Managing Director. Thank you both for being here and breaking down what we heard today. One of the things I found most interesting that Nancy was talking about just a few moments ago is what's next. What are we looking for next now from the Fed? And I'm wondering, from your perspective, Allie, what do you think is next? Is it looking at consumer sentiment?
So look, we've all been talking about the fact that, I'm about as old as the U of M, where I happen to go, consumer sentiment index, and it's the lowest it's ever been. In a strange way, it feels like in a lot of ways we are at this sort of nadir of opinion. And what happened today, which I think is a good thing, is that for the first time this year, it seems that the Fed and the Fed funds markets, i.e. investors, are about at the same place in terms of what the forward trajectory of interest rates look like. And so I think that Powell tried to give some more concrete feedback, which is what he has been asked to give in terms of prognosticating forward and saying that the next meeting in July looks like 50 to 75 basis points. Clearly, the 75 today and that confirmation that there is more to follow. He heard that the market was thinking or is ahead of the Fed. And look, so we now are at a point where multiples have come down about 20%. We've come from, somewhere between 21 and 26, depending on which markets you're looking at, to about 15 and a half, 16 times. So as everybody who's gone before me has said, we now have a lot of this priced in. So now that we have some sort of trajectory where it looks like fixed income markets and futures are bogeying about the same place as the Fed. And to the Fed's point, what they said today is we are doing everything we can to control the demand side of the equation. What we can't do is control the supply side of the equation. We've all been taken aback by the pernicious and the persistent inflation. So I think now, they are going to be short-term oriented, data dependent. They're going to get to that 3.8, maybe 4% mid next year. Hope there's a pause. Hope that the core inflation numbers, both that they look at and that the market seems to look at, come down. And to me, that all feels very supportive, because if we can get interest rate volatility much more stable, then we can start to get equity market volatility more stable. And then we can start to invest for what I think a lot of our time horizons are with our clients, which is not tomorrow or the next day or even the next Fed meeting, but is 12 to 24 months from now.
Yeah.
Alicia, what are you telling your team tonight? What are you telling your clients tonight, or your team's clients tonight, about what happened today, and specifically about whether the Fed can thread the needle and come in for a soft or soft-ish, I think was the word used, landing on the economy?
Look, I think today was very positive, and that's our communication today and tonight, actually 5 o'clock. Because we do think that the Fed really needed to seize the conversation really away from the market and the chatter and the concerns about Fed credibility and Fed willingness to really attack the problem. So I actually think this was a very positive move. I also like that Chair Powell did not box himself into any numbers in the next few Fed meetings, which I think was a mistake last time, obviously. So I think that's good. There's Fed optionality there. What has happened is the market quickly moved to a 4% terminal Fed funds rate next year. The Fed is below that, so slightly more dovish than the market itself. But we are priced in for it to go well if certain things happen. The real question here, obviously, the Fed cannot control the supply side, so it cannot control zero COVID in China or energy or food prices, but it can control housing and it can control the demand of things. And so if they get a little bit lucky, and I'm going to use the word luck because it's been very difficult to predict this. It's gone the other way against what most people have been saying, but we think it's positive. The next data print will be the PCE data. The core PCE is probably going to be lower by a factor of a couple of basis points than the core CPI. That will all feed into the Fed having it put together. So pretty positive today.
Was there anything that you thought this is really missing? We really should have had more clarity on, as Nancy was mentioning, perhaps the balance sheet, getting more information on that. What are you looking for, Alicia, in terms of what was missing?
So the other thing that was interesting, and I'll respond to your question, the Fed is actually signaling that we're going to have a bumpy landing. If you look at the increase in the employment rate, in their economic projections, and the slowdown in growth compared to 3 months ago, they know that the only way to do this is to really slow growth. So we shouldn't be surprised. Inflation is the first thing they're thinking about. I do think there was a surprising lack of communication about QT, quantitative tightening, and the rolling off of the balance sheet. And the Fed has said that $1 trillion is about 50 to 75 basis points of tightening. That can take a year. But don't forget, in the fourth quarter of 2018, there was some market dislocation in the reverse repo market. So I think that QT will continue, but it is a little bit much more of a question mark than the rates path and the rate expectations.
Yeah. Allie, one last word to you in terms of what you're looking for next, but what was missing today that you think we'll see more clarity on going forward?
I think that, to everything that was just said, that there was sort of a meeting of the minds, of the investment minds and of the Fed dialect, rhetoric, and movement. And so I think that as long as we can continue on that path, and as long as the tightening continues, which has continued, right? Mortgage applications are down by half. We've already started to see layoffs. There's a lot to overcome. But I think that as long as they can continue to have a lot of optionality, but be very specific, that the market and the Fed are going to continue to come together. And that is what you need in order to have some sort of progress and create support for the market. So that's what I'm looking for, to continued credibility building and specificity around the ability to keep on going and keep on being data dependent and be as aggressive as need be.
Excellent, excellent. Allie, Alicia, thank you very much. We appreciate it. Appreciate your time today.
Thank you.
All right, interest rates, inflation, punishing markets. It's enough to fill almost any client or advisor with worry and confusion, and that can have a very real impact, obviously, on investment decision making. I know, I've made those mistakes. So how should we take that all into account? Let's bring in Dan Egan, Vice President of Behavioral Finance and Investing at Betterment, and Brad Klontz, CFP and Managing Principal of Your Mental Wealth Advisors. Well, I love the mental wealth advisors, Brad, so I'm going to start with you because here's the trifecta that's got me. Number one, I feel a lot less wealthy than I did 6 months ago. I know that I'm paying a lot more for my staples and things than I did 6 months ago. And now I know that interest rates are going to be high and inflation is going to continue to be high for a good long time. How do I emotionally work my way through that triple threat of issues so that I don't, working with my advisors, so that I don't make mistakes?
Well, just as you're talking, I mean, my hands are starting to sweat. I'd be surprised if the advisors watching this program aren't nervous. And if you aren't nervous, you're probably lying to yourself and out of touch with your emotions. No offense. This is what's happening to all of us. And what happens when we get really stressed is psychologically, our survival brain kicks in. And one of the things that happens is our frame of reference gets much more narrow. And this is a survival technique, right? It's to look around, how can I survive this latest threat? And so what we have to do is, as we're calming ourselves, is to try to expand that frame of reference, looking at, for example, a much longer Dow chart. Like, once you stretch that out over about 10 years or 20 or 50 years, I'll feel a lot calmer than looking at what happened Monday, Tuesday, Wednesday, Thursday of this week. That is one of the things we need to do for ourselves and our clients. And we're not immune to this stress. A study we did back in the last Great Recession, 90% of the financial advisors that we surveyed had symptoms of post-traumatic stress themselves. And so we are certainly not immune to this. Many of us are managing the money of the people that we love, we care about, not just our own money, our family, our friends. And so I think, first of all, we have to be able to calm ourselves by widening out that frame of reference to give us, to let us think more clearly.
Dan, does it make sense to share that with clients, that you're not alone? We're feeling the same way. I have a family. I'm dealing with some of the same issues that you're dealing with, but this is how we're approaching it. How honest can you be as an advisor about your own emotions and what we're dealing with? You're all human.
Absolutely. I think, people come to you both for your expertise, but also your trustworthiness. And so being honest about the anxieties that you're facing, that you get through them as well, that actually inspires a lot more confidence than trying to deny what's going on right now. That said, I would say that don't necessarily assume that your clients, who might have more focus on what's going on in their lives, are as in touch with the markets and what's happening as you are. You're probably even more stressed than your clients because you're living this. Some things that we're seeing very, very low levels of any kind of defensive or stress movement amongst our client base. If you took 10,000 Betterment clients, you'd see about 2 doing something defensive over the course of the past week. If anything, they're logging in at lower rates. This is a very common coping mechanism called the ostrich effect, which is that if you know something's going to make you feel bad, you don't look at it. And that's actually quite healthy.
Yeah, but they have to look at it, right? I mean, eventually, that's part of what you're trying to impress upon them, Dan, is that they should take a look at it. I am wondering, when you look generationally at where people are and how they're investing and how concerned they are about what we're seeing, for those who've seen it before, perhaps they're not as emotionally invested or as emotional about it. For those who are seeing it for the first time, and I'm thinking of new investors, it may come with quite a shock from what they experienced over the last several years. So how do you deal with those emotions, Dan?
I think they actually have more tools to get them through this than we give them credit for. A couple of things that newer investors over the course of the past decade have benefited from. There have been numerous downturns that were 20% plus. That they got into the habit of saying, well, it'll go down, but it'll come back up again. I've got time to recover. That mental model will do well for them in this setting. There's a lot more support, either being honest about how you're doing or online groups that can say, yeah, everybody's going through this. You are not alone in it. So while I think that the inflation is going to be new and scary, it's not necessarily true that it's here to stay for a very long time. It's the money in the 2 to 5 year period that would be causing stress. And I think if it's less than 2 years, inflation doesn't have long to bite. And if you're looking at 5 years plus, inflation might not matter as much. Those 2 to 5 year goals, your standard sort of house down payment goal, those are the individuals who I think are facing a very stressful environment right now.
Brad, why do we tend to make bad decisions at times of high financial stress, and how can advisors and clients avoid it?
Yeah, I mean, bottom line is, when we become emotionally charged, we become rationally challenged. Your prefrontal cortex thinking, planning brain will shut off because you get into survival mode. This is just how we're all wired. And the way around that is to take a broader perspective and to find strategies to calm yourself down. It sounds pretty trite, but taking some deep breaths. It's one of the roles we play for our clients too, is sort of a stopgap between that emotion to run when everyone else is running. This is a very human experience, right? Everyone was a swashbuckling risk taker about a year ago, and now everybody's a scared little rabbit, running to go hide in the bushes. This is just how humanity operates. And so trying to avoid some of that catastrophic thinking, and the type of thinking that just pops into your mind, oh no, markets will never recover, this time it's different. All these things just add to that level of anxiety. Another hack that I think is super helpful is harnessing the mental accounting thing. And so rather than looking at the S&P 500 all the time, a lot of our clients have, a couple different buckets. They got a fixed income bucket, they got an equities bucket, and something that worked really well for our advisors in the pandemic was to run a report showing those 2 different buckets. And yes, this bucket's not doing so great, but for your fixed income asset allocation, we could perhaps draw on that for 10 years without even having to worry about those equities. And so I think a lot of those reframes can be really helpful for clients.
One of the things, Dan, that occurs to me, that gives me comfort sometimes, is to think of this is a time where we've seen the markets, the equity markets, go down a lot, is to not think about where I was on January 4th when the market peaked and I felt really affluent, but to look back and say, okay, today I'm back where I was in July of 2019 or July of 2020. And I go, well, then that's not so bad, because I didn't feel all that unrich in July of whatever it was, 2019. So maybe I've lost 2 years of gains here this year. They may come back. Tell me about whether that's a valid way to, or am I just deluding myself by doing that?
No, I think it's a critically good point. One of the ways to think about it is that you took 2 steps forward and then 1 step back. The past decade in markets has been absolutely fantastic. It's perfectly normal to have some brush fires and get things back to normal. Being able to say, so Betterment tax loss harvest for our clients, where we're constantly looking to sell things to offset ordinary income taxes. And this was something that I was wondering about, is like, actually, how far back do I need to go to know that I would no longer be able to tax loss harvest, because I'd be certain to be in the gains? And it wasn't that long. The 3-year returns are still very positive. So there's a lot of positivity if you have that broader time horizon, exactly what the other guest was saying. The other element of it that I think is key to touch on is keeping a focus on the future. So if you have something you're saving for, if you are saving for retirement or for your kids' college education, I logged into my own retirement account today to say, what happened here? And whereas before I had, I think, a 74% chance of having a great retirement, now I have a 69% chance.
Yeah.
So that same thing was saying, like, the decision I make today influences my outcome in the future. So what am I thinking about for the future? Not yesterday, not the past. That focus on the future is very powerful.
Yeah, it's so, I think we're all human beings here, Sharon. You make it. I've got a sophomore in high school who's going to go to college in 2 years, and believe it or not, I'm going to retire sometime, and not all that far off. So this is really live stuff. I almost said something else. Really live stuff for us all. Dan, Brad, thank you for your wisdom today.
Thanks for having us.
Thank you.
We appreciate it.
It absolutely is live stuff. We're all thinking about it right now, Tyler, and what we're going to do. And, the Fed is trying to help combat higher prices from the pump to the grocery store. Right now, many clients, investing isn't really what they're focused on. It's taking a backseat to some of their more immediate concerns, simply trying to pay for daily life. So how should advisors help keep clients' long-term goals intact while helping them also focus on those pressing financial needs that they need to deal with right now? Joining us are CNBC Financial Advisor Council members and dear friend Stacy Francis from Francis Financial, and President and CEO of 2050 Wealth Partners, co-founder and CEO, Lazetta Braxton. Lazetta, Stacy, thank you very, very much. I think Tyler brought a good point to deal with how you cope with your investments at this time, but also your overall financial life. Remembering where you were in the really great times, well, that's fine. But where were you in July, in June of 2020? And when I think about that, I think about what I was doing with basic daily financial moves, as well as where I was invested. Is that what you're trying to help your clients do right now, Stacy? Focus on how they deal with day-to-day expenses so that they can then feel comfortable about the long-term moves they've already set in place.
Yes, and actually, 2020, we were all hunkering down, and, you saw consumer spending some of the lowest we've seen in decades, and unbelievable savings, which was really exciting. But there definitely are concerns, and while interest rates are needed to increase to really cool the economy and bring down inflation, that 75 basis point increase and further expected in the future, it means that debt is more expensive. And while it's expensive for when you're going to the pump, it's expensive when you're going to the grocery store and getting milk, we're seeing a lot of people struggling with even some of the bigger things like housing, car purchases, college costs, and more.
Lazetta, I'm thinking back to, again, March of 2020, when I was frankly covering this all the time. I was frightened, and I wanted to think about what I could do so I could, think in my reporting of how I would cover more positive things. And I was, though, still focused on the 401k, focused on retirement savings, but it was the head of research of retirement research at an investment firm who said, focus on your liabilities, focus on your debt. And I'm thinking, I'm calling you for some quotes on 401ks. You're talking to me about focusing on debt. Is that what you're telling your clients now, Lazetta, so that they can cope with being able to pay for some of the daily expenses that keep rising?
What I want to comment on was that foresight of saying focus on your debt early, so that when the market is doing what it's doing, that you be prepared for that. So Stacy did comment about debt being more expensive now. Debt also means, higher mortgage rates, higher just personal loans if you need to, refinance that consumer debt, et cetera. So when it comes to our particular clients, we were doing just that, making sure that their cash flow that they were holding on to because they couldn't go anywhere, they couldn't eat out at the time in 2020 with the pandemic, changed as well too. And so hopefully a lot of the people who are listening in took some of those precautions. If they didn't, then you just have to accept what is happening now and make some trade-offs. So if you didn't buy that home and you didn't refi, really thinking, can you squeeze it in, and what does that mean for a change in payment? Or it may not even make sense anymore to refi on that mortgage. If you need consumer credit, more exposure to that, that also means that you probably need to scale back on some lifestyle creep that might have happened because you did get comfortable during that time when the market was still, pretty good.
I think you raise a point there, Lazetta, that makes me think of something. When inflation hits, it tends to hit the lower income quartile, let's say, of the population the very hardest. We talk a lot here on CNBC to people who have portfolios, and we talk about managing their portfolios. Well, there are tens of millions of Americans who really don't have portfolios. Can you give, for those people, some tips for ways they can manage their family budget in light of higher prices? Are there a couple of things, a couple of smart ways they can economize to make their dollars, their paycheck go farther?
I want to start with the fact that people that you're talking about, they're banking on their human capital to be able to make the money they need to handle inflation. And so some of that means challenging the employers to say this is not feasible, right? And that's a risk. That's a risk of losing your job if you don't have that leverage, if that employer can find other help. That's very challenging. The other aspect that you're seeing is a lot of families, moving back in together. So paying attention to, young children in terms of leases, because we see what rents are doing now. The average rent is like $2,000 a month.
Yes.
That is totally insane. So there's going to be some consolidation that happens and families having to get along better together in smaller quarters and just kind of in survival mode. Unfortunately, that's the case.
Yeah. The one quick question I had for both of you before we go is how you tell clients and prevent them from calling you saying, I want to just go all cash right now, or I want to take a portion and go to cash, or I want to stop the regular contributions that I'm making to this brokerage account because I just want to have more cash. Are you getting those calls? And when you do, what is the script? Stacy?
Yeah, Sharon, we're not really getting too many of those calls. We're getting calls just being concerned. And we understand that. We're technically in a recession, depending on the numbers that you look at. But we are getting concerned. And what that tells us is that the portfolio that client is in most likely isn't the right portfolio. Many people, when they're first investing, feel very aggressive, and they don't really realize their risk tolerance until they see a loss. And so it's a great opportunity for us to talk about, number one, how we've recession-proofed their portfolios and how they're doing a lot better than the market. But more importantly, that when it does recover, which it will, we need to put a new pair of glasses on and look at that portfolio and make sure that the risk that is in it is appropriate. Because if they're having sleepless nights because of this market, it means that there's too much equity in there and that we need to look at potentially rebalancing for them.